Ladies and gentlemen,
Good evening.
are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
Hi, this is Joanna Oakey here, and welcome back to the Deal Room Podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. Now, today we are talking tax. Now, before you go running for the hills, don't worry, it's going to be an interesting conversation, I promise. It's all about the warning stories about getting tax wrong at exit. And in order for us to talk about this scintillating topic, I promise it is, we have Nigel D'Souza from ADX Accountants. Now, Nigel describes himself as someone who has a keen interest in assisting clients with small business CGT concessions, tax structuring and advisory matters. And Nigel's standard quote apparently is understand the client's requirements by stepping into their shoes and deliver practical tax solutions without the jargon. Now, tax solutions without the jargon is exactly what we're going to deliver to you here on the podcast today as we dig into some warning stories all about getting tax wrong at exit and what you need to keep in mind if you're looking at any sort of exit from your business into the future. Well, without further ado, here we go with our discussion with Nigel. Nigel, welcome along to the Deal Room Podcast. It's such a pleasure to have you on board.
Thanks, Joanna. It's a pleasure to be here. It's an interesting topic, so I'm looking forward.
Absolutely. Now, it's not just a tax accountant that finds this whole concept of tax at exit interesting, can I promise you? Because when I start talking to my clients come in, what quite often happens, and I just want to set the scene here because I think this is so pivotal as to why we're actually talking about tax today. Why I do like to talk about tax a bit, because I would say when our clients come into us to exit from a business, in many instances, they come to us for the very first time right at the end of the transaction. So that's at the point where the business has been on the market, a buyer has been found, they've negotiated commercial terms, and then they come to us. And then, one of the first questions I say to them when they come in is, do you understand what your tax impact will be at the end of the day? Do you understand how much cash you'll have in your pocket? And they'll come back with one of two answers. So generally, it's either, yes, and I know that means no, or no, I haven't thought of that. It is so rare that I have anyone who comes in and actually says, yes, I have worked this through thoroughly with my accountant, and I understand absolutely what that's going to look like at the end of the day. So the problem is, so we have the situation where so many businesses just don't understand what the tax element will be at exit. And I say, okay, let's talk about the legal side. We can get all of the legal side ready, but before you exchange contracts, and actually before we even draft this contract for you, highly recommend you go sit down with your accountant and work it through. Make sure you fully understand what that tax looks like and what that cash in your pocket will look like at the end of the day after the deal is done. And it's just so, it shouldn't still shock me, but it still shocks me how many times they come back and say, gosh, I just had no idea that because I'm making these choices, this is the impact of those choices along the way. Or because I made this choice about structure 4 years ago or 20 years ago, this is the impact on the sale today. And so that, Nigel, is a very long introduction, but it's I guess it's the reason why I want to talk about this. Yeah. And, having come at it from that perspective, can you maybe, and of course we're talking today about the warning stories about getting tax wrong at exit, which suggests that maybe there are some instances where people have got this wrong, which I can testify to. I've seen many of them. But can you just talk about why do people get this wrong? Why is it that, how is it that business owners could get to this point at exit and maybe not even fully understand.
Yeah, Joanna, look, it's a great point you make there that, people tend to think about tax implications either when they're in the process of selling, or sometimes even after having sold their business, they will see a tax accountant. There's some good reasons for that. Among the reasons, one of the big reasons is that, selling a business or selling your shares or your assets, it's quite an emotional sort of decision. And, people are caught up, with the actual negotiating process to sell the business, but and sometimes they also get caught up in the due diligence process to sell the business, but tax sometimes gets forgotten. So, from that perspective, it is something that we do see not very often, but we sometimes come across, especially with new clients, that we get a new client that, sometimes they haven't had a chance to look at the tax implications of selling. And in those situations, what we sometimes find is that, there's anomalies that can happen from a tax perspective. Sometimes they think they're eligible for certain concessions or, CGT concessions, and sometimes they might not be eligible. Or in other situations, they are eligible and they're not even aware of the fact that they're eligible. So it's an interesting topic, but it's something that is it's something that needs to be considered, and it does require quite a bit of planning. And the earlier you have a chance to see an accountant, the better it is.
Great. Okay. Now, we've got quite a few podcasts where we work through, what concessions are available. How do you ensure you're eligible for them? But let's just give it a quick summary, though, for anyone who isn't aware of some of these, finer points of tax at exit. What are some of the critical things for them to understand about what tax concessions are available?
Yeah, so Joanna, look, the most critical things for them to understand is what concessions are actually available to them. So the first thing you got to identify is what kind of a sale is happening, right? Because we quite often look at a sale as I'm ready to sell I worked in my business for a number of years. If it's a small business, for example, I'm getting ready to retire and I'm ready to sell. But sometimes what will happen is that's one reason a sale will happen. But sometimes what might happen is you might get approached by an external, somebody, a competitor or something like that, that's interested in buying your business because your business has certain attributes that they find will add value to their business. So the process of selling is something that it's something that you need to actually plan for well in advance. And in terms of the actual things you need to look out for, I guess you need to have a bit of an idea of how the concessions work, so that if there's anything you can do in advance of a sale, you at least have a bit of an opportunity to rearrange things to a certain extent. And from that perspective, that could mean the difference between being eligible or just falling outside of the eligibility for these concessions.
So you talked about eligibility, and what are we talking about here? Eligibility for small business concessions or parts of those? Because I guess there's a whole host of different potential concessions available. Yeah.
So in terms of the eligibility, look, there's four different. I'll just talk about the concessions first, and then very quickly, because the eligibility sort of flows through based on the concession. So the four concessions are basically the 15-year exemption. Okay. Then you have the 50% reduction. Then you've got the retirement exemption, and you've got the rollover. So those are the main concessions, right? And in addition to that, if you've held certain categories of assets for more than 12 months, you are also eligible for the 50% discount. Now, the 50% discount applies over and above these concessions. I guess the objective of the concessions is you could potentially have a zero tax outcome, and if you're not eligible for all of them, your tax bill might be very significantly reduced. Now, in terms of the eligibility, like there's two main gateway sort of areas that make a taxpayer eligible. One of them is the $2 million aggregated turnover test. And the way that works is basically if you're in a business, if your turnover is less than $2 million on an aggregated basis, you will meet that particular criteria. The second concession, and this is the one that it can be quite tricky, is the net asset value test. And that to satisfy that concession, if your net assets, okay, when we say net assets, we mean your assets less your liabilities, are less than $6 million, you will satisfy that concession. So those are the basic conditions. And in addition to the basic conditions, there are some specific conditions that apply to each of the 4 different concessions that we just spoke about.
So just as a point of clarification, do you have to satisfy both of these eligibility requirements? So your business needs to be, you need to have turnover under 2 mil, and you need to have net asset values of under 6 mil?
So Joanna, basically the way it works is that you've got to satisfy one of the, either of the 2 conditions. So you don't have to satisfy both. It's either or. Look, that does offer a bit of flexibility because you might have a business, for example, that their turnover is relatively low, okay, but their net assets may be a bit higher. So, and a good example of that is due to the recent situation with COVID, what it has caused is it's caused a decline in turnover in some businesses that are otherwise quite valuable. So in that situation, they might be in a position where they will satisfy the $2 million aggregated turnover test, or maybe just under 2 million, but they might be over the $6 million net asset test. So it's either of the 2 conditions that you need to satisfy.
Brilliant. And let's talk about this $6 million net asset test, because I understand that it's not just necessarily related to what you actually own in your name, but it can also include entities that you might have a shareholding in. Maybe can you talk to us a little bit about that?
That's right. So you might recall I used the word aggregated turnover earlier in the discussion, and the reason for that is because there are aggregation rules. So basically, the way the aggregation rules is you've got to consider if there's any affiliates or connected entities in the structure. So when we're talking about affiliates and connected entities, the affiliate rule is arguably a bit more complicated, because you need to kind of work out if the directors of the company, for example, are acting as directors in another company or sitting on other boards, or and this is especially important with founders or people who are like in a lot of startup businesses. They might be potentially acting in a decision-making capacity in a number of other businesses. So if that happens, then you actually have to look through to see whether they're influencing the businesses enough that the turnover of the other businesses are actually got to be aggregated. Turnover or net assets, that is, of the other businesses have to be aggregated with the business that is being sold. So the affiliate rules, it calls for a bit of a in-depth analysis to work out whether you are caught under the rules or not. And there's certain sort of exceptions within the rules. So, for example, with spouses, a spouse is not automatically an affiliate, but in some circumstances, the assets of the spouse, if they're being used in your business, they might be considered an affiliate for the purpose of these rules. And so that's the affiliate rule. And the other rule to be aware of is the connected entity rule. So the connected entity rule is basically based on the percentage of ownership. So if you are generally above 50%, you are, if you own above 50% of a particular entity, whether that's a unit trust or a company, that entity gets aggregated with in terms of its turnover or net assets, depending on what you select. On the other hand, if you're between 40 and 50, you can apply, to the ATO, and in some circumstances, you might be able to prove that you're not connected to the entity. And if you're under 40, generally what happens is you're considered not to be connected to that other entity. So it's slightly different, but it depends on the percentage of ownership.
So let's turn this into, okay, well, what are the warnings out of that? What do business owners need to be careful of? And why is it relevant for us to think about whether or not another entity or person is considered a connected entity? So what is the importance of that classification of connected entity?
Yeah, Joanna, look, that's a good question, because what happens with the percentages is it can be quite easy for a client that's owning a certain percentage of the business to not realize that, if they're within a certain range, they might not be able to access the concession. So I'll give you an example that we had of a particular client. So this client, and this is not the connected entity test, by the way, there is another test which is part of one of the concessions that basically requires a taxpayer to own more than 20% of the shares in a business, okay, in order to qualify for the concession. So, and this is one of the specific requirements if it happens to be a share or a unit in the company. Now, in the case of this individual, what happened is they had been selling down their shares for a number of years. So initially, I'll just give you a broad example, like they might have owned 30% of the shares in the company. They needed the money, and so they decided, look, I've just got to liquidate and keep selling my shareholding down. And they got to around 21% of the company, okay? And at that point in time, we didn't know about this because this was a new client for us, but at that point in time, basically, this client wanted to continue selling their shares because he thought, I'm getting a good price. We're in the process of negotiating a deal with this new company. So how about I sell maybe 5 or 6%? And what would have happened in that situation is basically the shareholding of this individual would have dropped to below the required 20% threshold. Now, when it drops to below the 20% threshold, you're basically not eligible for the concessions anymore.
Other than your 50%.
Other than your 50%, that's
shares.
right, spot on. So other than the 50%. So that's a good example of how, if you are aware as a client of the concessions, you might rearrange your affairs or do things in a different way. So we went back to the client and said, look, this is the issue you have. You can sell, yes, these are the advantages, but from a tax perspective, the biggest advantage is if you hold on to your shares, and if you sell the whole lot or you sell a very big proportion of it, you can potentially qualify for the small business CGT concessions. And the benefit of that might be actually quite substantial. He did decide eventually that he was going to continue holding on to the shares. And basically, there were other reasons as well, because, as part of being a key individual in the business, this particular client needed to actually stay on in the business and not sell down any further. So that's an example of how a bit of careful planning on the part of the advisor, along with the client, can actually go a long way in maybe saying to the client that, hang on, have you thought about these things?
Such a good example that, where you can go from holding 21% and then not even realizing, I'll just sell 3%, but suddenly now you're below the 20%. And when you go to sell the rest, you don't get access to the same concessions as if you just had have sold it all in one go or held on to it and sold it later. And it's a really good point to be aware of, to be very careful about when you're selling down shares, the way in which you do it, the parcel size in which you do it. Actually, another point in that example that you made was they realized that there was an importance of them holding on to equity because they were so integral to the business. And quite often buyers, will want to see some connection there between people who are integral to the ongoing running of the business as well. But that's a whole different topic. But I just thought it was interesting that you pointed that one out, because that certainly can be a fundamental aspect of what a buyer is looking for when they're coming in to buy to buy a company. Well, great. Okay, so warning: be careful about the parcel sizes when you sell down and getting too small in your parcel size, lest you then cut yourself out of being able to utilize some of these concessions. And one of the things that, we're talking about warnings here in relation to tax, but one of the issues that I have seen creep up from time to time is the impact that has been caused by distributions from family trusts. So trusts who have been the shareholder or within a company. Yep. The funds within that, that come from the dividends, the funds from that family trust have been distributed to certain members of the family, and the way in which those distributions have happened has had an impact on tax. Could you maybe talk us through what some of those risks are? Because I think many business owners just don't even realize that the way in which the distributions are dealt with from the trust to, the class of beneficiaries might have an impact at the end of the day on their sales. So maybe just walk us through some of those issues, Nigel.
Yeah, Joanna, look, this is where it gets a little bit complicated, because what tends to happen is when a trust owns shares in a company and these shares are being sold in that company, the 20% test that I just spoke to you about in the previous example doesn't actually apply. So there is a test called a 90% test that applies. And what that test requires is to actually track the distributions that occurred. And you've got to basically do an exercise where you go back to up to the last 4 financial years, and you've got to work out who's received the distributions. And if any of those people that have received the distributions, when you aggregate all of their distribution entitlements, whether they're in a position to meet the 90% test. And so sometimes it can be really tricky, because what tends to happen is, the distributions, sometimes the year before, they haven't really planned on selling the business. So they might distribute to a particular spouse or one of their adult kids or something like that, and they don't actually understand the implication of that, and that could actually impact the ability of, in some situations, of a client to access to pass this particular test. So what we recommend is basically to sit down with an accountant and work through what have been the distributions for the last 4 years. So this is what the test requires: work through what the distributions have been for the last 4 years, and then work out who are the individuals within that particular test that would qualify for the concession. So sometimes it's possible that 2 individuals might qualify for the concessions. If the distribution, the pattern of distributions have been in a certain way, it is possible that 2 separate individuals might qualify for the concessions. Now, why is that important, Joanna? The reason is because if 2 individuals qualify for the concessions, then potentially 2 individuals can contribute, can make a contribution into their super fund, because one of the concessions is the retirement exemption, and that exemption actually allows individuals to contribute up to $500,000 into their super fund, and the contribution will then basically come off your capital gain. So let's just say you have a capital gain of $500,000, which is remaining, and you need to deal with. You have a choice, right? You need to either pay. You have 2 choices: you pay tax on the capital gain, or you contribute the money into super. You could just contribute the money into super, and that's the end of it. You will not have a tax liability. So that's one option. But if you have two individuals that potentially qualify to make the contribution, then you could say, okay, I'd like to make a $1 million contribution. Now, in that example, that I used the example of a $500,000 capital gain, but in other examples, the gain might actually be a lot larger than that. So I guess these are the sort of things that come up in the analysis, and this is why it can get a little bit more complicated than people appreciate initially.
Well, absolutely. It does sound extraordinarily complicated. I can only but agree with you, Nigel. I can only but agree. But I tell you what this does demonstrate. It does demonstrate, number one, notwithstanding, you might have a bit of an idea of what those sort of general concessions are, and that eligibility, the 2 million turnover, the 6 million net asset value. It's a great stark reminder that there's a lot of complexity that sits underneath. The other thing that it demonstrates to me is that you really need to be planning this stuff well in advance. So if you're saying, you need to look back at the distributions that have been made over the last 4 years, well, I tell you what, if you think you're 5 years coming up to exit, sit down right now and absolutely involve your accountant so they're careful about the decisions that they're making along the way every year in relation to your tax. So I guess there's sort of those two perspectives, aren't there?
That's right, and it's also a matter of, so one of the, you mentioned sitting down with the accountant. One of the things that we sometimes can find, Joanna, is that there's not enough paperwork going back. If we use the example of the last 4 years, sometimes, like if a client has, for example, come from another accountant, the other accountant might not have prepared a set of financials because there wasn't much activity in that particular trust or in that company. So in these situations, it can be quite tricky to actually piece together what happened 2, 3, 4 years ago. And with some of the tests, there is, which we didn't speak about earlier, but there is this other test called an active asset test.
Oh my goodness, another test. Oh my goodness gracious. This is getting ridiculous. Oh my goodness. So, who thinks of all this stuff? Really? I mean,
Yeah, look, it's a bit of a tricky process, and it's something the ATO have said to, look, if we're going to make it really generous, where you can reduce your capital gain to zero, but at the same time, we want to see all the paperwork, and we want to make sure that you satisfy all these requirements. Otherwise, you're basically going to have to pay the capital gains tax. So the bar is set fairly high, unfortunately. Yeah. But what that also means is that it's something that like I was talking with the active asset test, you do need to have paperwork that goes back at least half of the period that you've owned the asset. So, for example, just to give an example, if you've owned shares in a company, let's just take shares, the last 10 years, what that test requires is that you need to actually look at the balance sheets of that company, work out if the assets were active, the assets being your shares, for at least half of the ownership period. So in my example, that would be 5 years because, the last 10 years, so it's going to be 5 years. But, some clients, they might not have the paperwork going back to the earlier years. Now, if it's, the ATO do have a concession with that. So, for example, if you've owned the shares for a period of 15 years and that period has been, it need not be continuous. You've owned the shares for 15 years in total, like the ATO will accept 7.5 years. So you don't need to keep going back beyond that. But that gives you an example of how it can be really important to do a bit of planning for these concessions, because let's say you discover that you don't have financials going back, or you've got financials for only 5 years, but you need 7 years worth of financials. Then you got to think about, what are you going to do, right? Is it worth actually going back, reconstructing the financials? Like, sometimes the financial have been destroyed, or the previous accountant has retired. So it can be quite challenging in those situations. And that's why I say that you do need to have a bit of planning, because when you apply the concessions, you've got to, submit the paperwork. It's all got to be done in accordance with a time frame. And you don't really have sometimes the luxury of time when a sale has already happened. The clock is basically ticking. So that kind of underscores the importance of actually having that discussion with the accountant.
Yeah, absolutely it does. Absolutely it does. Such important things that we're talking about here. And I think it's absolutely apparent from these examples that we're talking about that it is stuff that you need to plan in advance. You need to be aware of well in advance. You need to ensure that you're keeping the right things, that the right decisions are being made about distributions, about the purchase of assets, about company ownership, to the extent that that might impact your ability to your ownership of a small part of a company, might then impact the entities that are pulled in for the purposes of calculation of some of these figures. So, every decision needs to be thought through carefully with that end point of exit in mind and tax at exit in mind. So we've run through some of that stuff. I know you had some other great examples. Maybe tell us some other stories, Nigel. I love stories. Tell us some more stories of where things have gone wrong. All right. By the way.
Yep. Look, it's in terms of recent examples, like with the $6 million net asset test, that's actually an important one because, generally speaking, if there's some situations where you might be below the $6 million net asset test by quite a bit, let's say $1 million or $2 million, in that situation, you probably, you've got some room there, but it's situations where you're just a little bit above where the question arises, what's in the $6 million net asset test? So look, in terms of like examples, like we had a client that came to us and their assets were, we added up the assets. And when we're talking about the $6 million net asset test, I might just add a little bit of background just, to understand. What goes in there is basically, for example, cash in the bank, any assets that are investment properties or interest in shares and those kinds of assets. What doesn't go into the test is their superannuation, life insurance policies, personal use assets, for example, cars and stuff like that. And the other thing to be aware of is the word net. The word net means assets less liabilities. So you got to think of it this way. What are the liabilities? Okay. Do they have, for example, if it's an investment property, do they have a mortgage? So when you add it all up, obviously, if it's less than 6 million, you qualify. So we had this client that came to us and they were questioning whether they're eligible or not. And it looked like initially they were above the $6 million net asset test. So we added up the assets and the liabilities and everything, and we realized, hang on, they're probably going to be above the $6 million net asset test. But when we looked at some of the liabilities, we realized that there were additional liabilities that they didn't actually tell us about. Okay.
Oh, right.
Yeah,
that's right. What were the liabilities?
Yeah, look, they were basically loans that they put into the business, and some of the loans were not recorded, appropriately, and they had bank statements to prove that the money was spent on the business assets,
right?
And so basically that made quite a big difference to their situation, and it ended up they were under the 6 million by quite a bit. Quite a bit, because they'd been using quite a bit of their personal finances to fund the business, because this was it initially was a startup. Okay.
Yep.
And so they kind of like they ended up in a position where the net asset position was quite a bit under $6 million, but they thought, look, I don't think I'll qualify. But this is the other thing to be aware of. You don't make assumptions. Whenever you're working through the test, you generally start from position. Your position is zero, right? You start from zero, and then you sort of work through the rules very systematically work out what qualifies, what's in, what's out, add it all up, and then you work out if, we usually go to the client and say, is this all, or is there anything else? Things
is there
like
something you may have forgotten
exactly,
in there?
and remember, when we talk about net assets, we're talking also about market values. So market valuation can be a bit of a tricky area, right? Because you've got to think about goodwill, and sometimes you might get different valuations from different valuers, and that might actually push the valuation either above or below the 6 million. So like these are a number of different things that you would actually need to think about when you're in the process of doing that test. And it's not like any one answer is right or wrong, but where there's a lot of doubt involved, rather than make the decision, what we might do sometimes is go to the client and say, look, do you want to apply for a private ruling? Because the ATO can actually look at the position and give an answer based on what they think is the answer, and that actually offers a lot of peace of mind to the taxpayer, then knowing that, hey, look, nobody can challenge this $6 million this valuation because it's come from the ATO, and we are comfortable therefore with the position. So look, it is it's a bit of a
what a great example. I love it. And so do you remember how much tax we're talking about at the end of the day that they ended up saving?
Yeah, look, I can't quite remember the numbers, but in the earlier example, like that, they were about 1.5 million was the capital gain, because this individual invested at a they basically set up the company. They basically set up the company. They'd been in very early. So, they didn't pay anything for the shares. So basically the capital gain was pretty much the market value less whatever was the cost base of what, they contributed. So, and that gain was subsequently reduced by a number of these concessions. I mean, they were under 55, I will mention that. So there was a consideration of whether they wanted to pay the tax or contribute the money into super. But they decided to contribute the money into super, which eventually further reduced their tax bill. There was some tax in the end, because on a $1.5 million capital gain, there might be a little bit of tax, because if it's one individual, you might just get 500,000 as your contribution limit, and there might be something residual. So from that perspective, they did pay a little bit of tax, but comparatively, it was it was a really good outcome to be eligible.
Brilliant. Okay. Well, look, thank you so much, Nigel. You've walked us through some great examples here. It's just fascinating seeing, some of these, the complexity, I guess, and the importance of being on top of all of this. And I guess before we finish, are there any parting words that you want to leave our listeners with?
Yeah, look, it's a quite a generous set of concessions, but at the same time, it's something that you need to actually speak to an advisor about. And we do understand that clients are very busy, adding value to their businesses or on a day-to-day basis, and can be really difficult to actually understand some of these concepts. But the idea is that you do not need to be the expert and understand everything. You need to just engage with an advisor that understands how the concessions work, can work with the client, and if there's a need to work with the ATO, can actually work with the ATO and work out the best outcome for the client. So so that's kind of my the advisor's take on it, to just be aware that you've spent your whole working career trying to build up your business. Why not take advantage? These concessions are for small business owners, and we're in a difficult economy, obviously, the last couple of years. So it's something that you really need to take advantage of. And it's not just in the context of a sale, Joanna. It's also if you're doing a restructure, for example, you might want to sell your shares to your family trust. You might want to do a restructure for asset protection. The concessions apply in that situation as well. It doesn't have to be an external sale, but these are just some of the things you might want to consider.
Absolutely wonderful. Okay, well, look, if our listeners want to make contact with you, Nigel, and talk about tax, how do they go about doing that?
Yeah, look, I'm always happy to talk about tax. You can reach me on nigel@adx.com.au. So that's our email address, ADX Accountants. Happy to have a chat. Yeah.
Brilliant. Well, look, thank you so much for coming along to the Deal Room podcast. We'll put those details in the show notes. And thanks for coming along.
Thanks, Joanna. Pleasure.
Well, that's it. Just a recap. In this episode, of course, we were talking all about the warning stories about getting tax wrong at exit. And of course, this is a topic that I think is extremely important. At the end of the day, when you're sitting there at the point of exit, working out how much of the sale price is going to stay in your pocket, you might believe it's a very important topic as well. If you'd like more information about this topic, then just head over to our website at thedealroompodcast.com, where you'll be able to download a transcript of this episode in more detail. There, of course, you'll also be able to find details of how to contact Nigel D'Souza at ADX Accountants if you'd like any assistance with preparing for tax matters for the future or for a transaction that you're involved in right now. Of course, on our website, you'll also find details of how to contact our lawyers at Aspect Legal if you or your clients would like to discuss any legal aspects of sales or acquisitions. We've got a number of great services right through from advising in advance on all of the preparation steps if you're looking to exit or to acquire, and of course with helping you along with the deal along the way. And we work with clients both big and small, so don't hesitate to book an appointment if you'd like to find out how we might be able to assist. Well, that's it. Thanks again for listening in. You've been listening to Joanna Oakey and the Deal Room podcast, proudly brought to you by our commercial legal practice, Aspect Legal. See you next time. Aspect Legal has a number of great services that help businesses prepare for a sale or acquisition, to help them prepare in advance and to get transaction ready. We've also got a range of services to help guide businesses through the sale and acquisitions process. We work with clients both big and small and have different types of services depending on size and complexity. We provide a free consultation to discuss your proposed sale or acquisition. So see our show notes on how to book a time to speak with us, or head over to our website at aspectlegal.com.au.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.